Really focus on catching the big trends with Metastock. Really pleased to be associated with Jeff Gibby and the entire crew at Metastock. They're a tremendous organization, tremendous bunch of people. Jeff and his group worked real hard with my staff and I to really set up my favorite indicators, actually 14 different indicators within big trends to allow you to within the Metastock platform on how to find opportunities in the market, both to the upside and to the downside. So tonight I'm going to share with you some of my favorite tools for finding those bigger trends. And we are recording this session, so we'll send you out an archive link of this tomorrow when my associate gets a chance to upload it, and Jeff will be doing the same on his end. So let's go ahead and get into the presentation here. We're going to focus on several of my favorite indicators. Obviously, within an hour, I can't get 17 years of knowledge into just an hour, but we're going to try to get some of the best information in to get you a feel for just how powerful these indicators can be. If you have any questions, by the way, feel free to submit questions through the Q&A, and I'm going to do my best to make sure that the audio keeps coming in. I'm trying not to go too fast and at the same time try to move it along here. So one of my first favorite indicators is the technique called acceleration bands. And acceleration bands is a tool in which I'm really looking for strong moving stocks. And as you know, I like to trade options very often, much more than stocks. So, you get better leverage with the options and you have to commit a lot less capital. We still need to find the right stocks. We still need to find what are we going to trade. And, the beauty of Metastock is that it allows me to take my acceleration bands, a very different type of band compared to Bollinger Bands, and we'll talk about that here in a minute. But basically, it allows me to go scan for across any group of stocks, whether it's all the optionable stocks. There's 3,000 different optionable stocks out there, and I can't just possibly be scanning through 3,000 stocks a day. I'll just wear myself out and I'll burn out. And I know everybody's probably dealt with that at one time or another of information overload. And what we really want to avoid is information overload. We want to get you focused on exactly where you can find the best opportunities to the upside or the downside. So every night in Metastock, I just set the scanner to actually go run through my bands. And through what we call our Big Trends Toolkit, you can run through all these different scans, and it really allows you to focus on just a few names at a time and really get the best of the best situations. So what's the point of acceleration bands? Well, like I said, if I'm trading options, I really want to be able to leverage the move in the shortest amount of time possible. So we don't just want trends that are going to go steady up. We prefer to get trends that are going to go accelerating, more parabolic moves up, or the waterfall type of moves to the downside where they start to accelerate to the downside. That's where you're going to have a situation in which you can really find the biggest and fastest moves in the shortest amount of time possible. As you know, with options buying, we want to minimize the time that we're in the trade while maximizing the amount of trend that we get. So that's what we focus on. When I started trading, like a lot of you, I started with moving averages. That I found that, moving averages were a generally good trend definition, but they weren't defined enough. You were going to get too many different breakout or breakdown signals on a day-to-day basis, and you're going to be back to that information overload problem. Plus, I noticed that the best stocks never seemed to come back to test those same major moving averages because they were going more parabolic. Back in 1990 when I started trading, stocks like Cisco and Microsoft and Amgen and International Game Technology, all these growth stocks of the day, but they weren't coming back to give me a chance to get back on. What I find with my methods that you'll see throughout the presentation tonight is that I'm always looking for a way to get back onto a good trend so that I'll have multiple chances to get back on board a good up or down trend as opposed to just a one chance and done. Most of you have probably experienced, like I used to think, well, if you miss that first move, you feel like you missed out because now the stock is a lot higher than where you wanted to buy it the first time and for whatever reason didn't buy it the first time. Well, my methods will give you multiple chances to get back on board a good trend. It's still a very managed, low-risk entry point. So we're going to focus on that tonight and how to get on these best stocks, not sort of the mediocre performers, but really the strong trends up or down. So, when I started testing all the different possibilities of how do I get on these best stocks, I started to test a variety of adaptive bands. And what I looked at were Bollinger Bands and moving average envelopes and Keltner channels and all kinds of different techniques to try to find where's the right type of a band to really define where the stock is generally trading in a range versus where it's truly breaking out. We talk a lot of big trends internally here about breakouts versus fakeouts. I want to find the true breakouts and I want to avoid the fakeouts, because it's not just about you're getting stopped out more often, but I find that if you get stopped out in trades that are just fake outs, it's going to mess with your trading confidence. It's going to actually make you start to question your methods and make you lose confidence in your methods. I find that you're going to have a lot more confidence when you trade these type of methods, like my acceleration bands technique. Similar to a Bollinger Band, acceleration band should encompass on a 2 deviation setup about 95% of the price action. That means that if 95% of the time we're seeing it trade in between the bands, I actually want to trade the other 5% of the moves that are happening outside of the bands. Let's look at an example in our next slide. This is a chart of American Home Mortgage, AHM, which actually you can't find anymore because the stock is bankrupt, belly up, delisted, gone, wiped out. Well, this chart picked up a couple of the good wipeout spots on the way down. And so what we're looking at here are these 3 green lines that are plotted around the stock. You notice that the middle green line here is just a 20-day moving average. So this is just your normal 20-day simple moving average right in the midpoint of these bands. But the outer bands are actually my acceleration bands, and they're quite different, like I said, from Bollinger Bands. A Bollinger is going to tend to race to catch up, and it doesn't like for something to be outside of the bands for more than a day or two usually. Whereas the acceleration bands are a little slower. They adapt, but they're a little slower to catch up, so that they're going to allow you to really see where the breakout is persisting and ride a trend longer, say a Bollinger Band breakout. So from that perspective, I like the acceleration bands best within a trend. Within a trading range, when we're kind of stuck in the range, both acceleration bands and Bollinger Bands can be useful. But I'm really looking to trade outside of these bands. Let's look at the periods at which you really see that kind of an opportunity. You can see when we get 1 and then 2 closes outside of this band right here, we have this big move to the downside. And you can see, I probably need to adjust my colors here. But basically, what we're looking at is a situation in which we're really looking for one of these big breakdowns here. And when we get that breakdown, that's going to give us, right in this area here, that's going to give us our opportunity to catch the really the big move to the downside. So we're really looking for that kind of a move, and we're also then looking to get out. Okay, when that trend is over this phase right here, and remember, I'm looking for not just one close below the bands, but actually a second close below to get in. Whereas it only usually takes me, on just trading the bands by itself, it usually only takes me one close back into the bands to get me out. What you can see is happening right as we shoot up here, right there on that particular bar. You got to get out right there. But the stock's gone from 28 to 20, and then it snaps back up at about $23.50, $24 to stop you out of the remainder of the position. One of my rules when I trade options is if I double my position, I'm going to seek to get out of half at a double. So I will have a chance, obviously, on a move from 28 to 20 to make more than a double. So I've already locked in half so that when it does hit the eventual stop on the remainder, I'm not worried about trying to get it back down to $20. I'm saying, I'm going to go ahead and say sayonara to that trade. Now, interestingly, when you see this next breakdown here in early April, this is a second close right here below that acceleration band. But, you're going to see as I go through that, acceleration bands was where I started back in the 90s and the early 2000s. In recent years, I've actually added a couple or several important filters to it. And as I said, we've got over a dozen different indicators in the Big Trends Toolkit for Metastock. But, we're just focusing on a few of them here tonight. But these are a few that when you use them in conjunction, it's going to be more powerful than just using any one indicator by itself. So this is building blocks. I'm just showing you the first building block. When you see later on that the early April signal, if you're just trading acceleration bands, you'd have had to get out when it got back into the lower band right there, and you'd have lost about 10% on that particular stock move. But the point is that when we add in the filters I'm going to show you, like my %R and efficiency filters, that bottom line is that it actually prevented us from taking that trade because we just weren't quite there yet. But you notice then over the next couple of months, we're basically stuck in this range. You can see we're hovering in between the lower and the upper bands here. We're just not making any kind of movement outside of those bands. Do I want to trade if we're stuck in between the bands? Some people will tell me, oh, well, your bands are good for support and resistance price. You should buy the low band and sell the high band. Well, that's just trading for the pennies, not trading for the big dollars. It's not trading for the bigger move. One of my friends, Tom Dorsey, calls it picking up nickels in front of a bulldozer. But the point of that is that you're trying to scrape out little gains, but you're missing the big move that's coming, and you may well get run over by it if you're buying the low band and then we break down under the lower band. So you see what happens. We break down under the lower band here in late June and confirmed with the second bar below that band right at the beginning of July here. You're getting that opportunity to say, okay, that's a second day in a row below that band. It was confirmed by our other indicators, which we're going to talk about later. And look at how that move just continued to decline, and you never got back above the lower band. And we actually, on that big gap down below 5, that bar, we actually just locked in our profits because it was like under 5, we're going 4 and 3. It was saying, how much more can you go to the downside? Well, you can go to 0. This one actually did, but obviously we were getting concerned down under $5 that, how much more could we bounce versus how much more could we go down. So we made the bulk of our profit on that big gap down. What was that gap down? That gap down was when they announced that they were laying off most of their staff and that they were having major funding problems. This is the prime stocks having major funding problems getting their debt funded, and basically they were at risk of bankruptcy and, of course, ended up going bankrupt. And so, my point there is that, okay, that news hit at the last day of July. Guess what? You think anybody had a clue that maybe that might be happening before that big gap down below $5? Absolutely. I mean, that's what these indicators pick up, is they pick up unusually strong buying or selling pressure. In this case, unusually strong selling pressure. So from this perspective, you're looking at a situation in which you really pick up that strength of movement to the downside. Obviously when the stock broke down there at $18 and we're buying 20 strike puts, that becomes a very valuable option. Even though the option seemed a little bit expensive at the time, they were expensive for a reason, and you caught a big move to the downside. You would only get stopped out using the acceleration bands methodology if, in fact, you were getting a close back above that lower acceleration band, which you can see it never even came close in that July move. So, a good example on the downside of how to trade these kind of moves. So that's what we're looking for, are these big movers on the downside. So that's the first sample I wanted to show you. We're going to come back to this chart when we add in the other indicators in a minute. Let me clear out the okay, there we go. The point I want to make about what kind of option do you buy. I'm not the kind of go-go super hyper-aggressive trader that's saying you should buy cheapy options and go for the monster home runs. It obviously has great marketing sizzle, but it doesn't work in the long haul. What works is taking a more conservative but still very nicely leveraged approach. And so what I do is I actually buy in-the-money options. I actually will look for these kind of opportunities where I'm buying in-the-money options, and I'm going to really seek to get rid of as much of the time value as I can and really focus on the intrinsic value. So from my perspective, if I can get at least 2/3 of the option's value as intrinsic value and no more than 1/3 as time value, that's my ideal parameter. So for example, if you were going to sell short XYZ stock, say at a price of $56.60, well, that would cost you some amount of margin, usually about at least half of that $5,660 you'd have to put up as margin. You're locking up almost $3,000 of margin money. Well, instead, if I bought, say, usually a front month or a second month 60 strike put, like right now we're getting a little too close to the October expiration. Frankly, I'd say right now I'd be looking for the November expiration, usually like about 4 to 6 weeks out. And I've got a 60 put. What does that mean for those that are new to options? It means that I've got a right to sell the stock at a price of $60 a share. In this example, good until the third Friday in October. Like I said, I'd probably look into November. The third Friday in November is a November expiration date. But bottom line is, we'll use this example. In the third Friday of October, well then, I've got a right to sell at 60. What's that right worth intrinsically right now? Well, if the stock right now is at $56.60, you've got a right to sell at 60. You could theoretically exercise the option, sell the stock at 60, go back in the open market, buy it at $56.60, and what would you pocket? That difference is $340. So we're paying $470 or $470 to control 100 shares. So what's that other $130 called? If $340 of it is intrinsic, the other $130 of it is time. So if you do the math in this example, you're looking at a situation in which you've got basically 72% is intrinsic and 28% is time. So that fits in my ratio of at least 2/3 intrinsic and 1/3 time. So from this perspective, we're looking for a situation in which we can really get an opportunity to minimize our risk. Because what is your risk if you're going to be in a situation in which you're dealing with the stock flattening out, going nowhere? If you're just stuck waiting on it and it hits the expiration date and the stock's still at $56.60, what will you lose in this example? You'll lose $130 or the time portion that you paid. If you're buying an out-of-the-money 55 strike put, what percentage of that is time risk? All of it, 100%, right? Because if it doesn't go under 55 by the expiration, the option wipes out on a 55 put. On a 60 put, you're still locking in the intrinsic value. The option can't trade under the intrinsic value, or else it would bring in arbitrage players who are locking in a risk-free profit. The bottom line is that that's why I like the in-the-money options. The more time premium you pay as a percent of the total, the more risk you're taking on if the position flattens out. Of course, if the stock goes up and you're thinking it's going to go down, you have risk there too. But here in this example, if it went quickly back to 60, you're still going to have some time premium left where you can still manage your risk better with an in-the-money option than you can on a percentage basis than you can with a out-of-the-money option. So let's say the stock goes to 50. In this example, you look at it and you say, well, I've got a right to sell at 60. Now we're at 50. What's that intrinsically worth? 10 points or $1,000 on every 100 shares. So that means that you make 1,000 compared to the 470 put up. The in-the-money option would gain $530. Again, this is before commissions, or 112% gross. Compared to the short stock would gain just 11.7%. So you can see in this case, that's a 9.5 times leverage ratio. So we're doing 9.5 times leverage in this case. So basically, we're looking at a situation in which we're really getting a tremendous leverage ratio to trade that option compared to that stock. Now, the more you trade for the bigger trend, the better off you're going to be. Whereas if you're just trading for little half-point moves in the stock, you're probably better off just trading the stock if you're a day trade scalper type. You're better off in the options if you can trade the bigger trends for the bigger moves. You're going to really see the leverage potential add up much more dramatically in that situation. So that's the in-the-money strategy. We're going to now talk about the Williams percent R indicators, another unique tool. This is one that you can find on a few platforms, but the way I do it is so different that you really need to see this to believe it. Williams percent R is very similar to stochastics in measuring the overbought and oversold levels. Now, the Williams percent R scale is actually quite different than stochastics or RSI. It actually uses a scale of peak of 0 down to a lowest possible reading of -100. It takes a little getting used to if you're used to looking at a 0 to 100 scale. We're now going from a peak of 0 down to a low of -100. This is important. While most use a 10 or a 14 bar setting for percent R, I don't. I use a 30 bar setting. So what I've done in all my testing is I found that 30 bars is very, very effective at allowing you to really focus on the best situations. So we're looking for that 30 bar setting, and that works out to be on a daily chart about 6 weeks at a time, which fits with why I like to trade about 4 to 6 weeks out. It's going to be smoother, but still very responsive to changes in the trend. That's what we're looking for in this example. My rule of thumb is actually the exact opposite of what you would expect if you were trading an overbought or an oversold indicator. Most of the time, if you hear the word overbought, all the traditional trading says what? Should you get in or should you get out? Most traditional texts would tell you to get out of an overbought situation because they say, well, it's run too far, it's at the top of its trading range, it's likely to come back down. Well, the Big Trends approach and the Big Trends Toolkit through Metastock picks up a totally different spin on this, which is based on my testing. I didn't just randomly come up with this. I tested it and found that actually if you find an overbought situation that keeps going overbought, it's actually very bullish. I'm sure you've seen stocks that have done this where you hold off from buying that overbought stock and you just keep watching it race higher and higher. And has anybody had that experience, especially in the recent run-up in the market? I'm sure that you have, because basically, you're seeing so many of these great overbought trends in the market right now that they're staying overbought, they're acting very bullish. That's bullish until it breaks down. I'm going to show you how I write it and also how you can get out. So feel free to submit any questions or comments through the text window. I'll be happy to get to those as we get through the presentation. Well, now what's my rule here? In this case, if I get an overbought reading, for me it's an overbought reading if it goes above that -20 reading, which is the top threshold, the top 20% threshold. Well, guess what? What I do is if that bar's high is going to hold up and it's not going to close above that bar's high, then yeah, it would be the top of the trading range. But instead, if it does something unusual and it actually has a close above that bar's high, then that's going to actually tell me that it's not the top of the trading range, but instead it's going to be the start of a bullish trend. And so that's very unusual, but when it happens, again, the minority of the time, but when it happens, you get the big opportunities to really trade the super strong trends. You can do this not just on stocks, you can do this on Forex, you can do this on ETFs, you can do this on mutual funds, you can do this on pretty much any kind of data as long as it's got, close and preferably open, high, low, close bars. That makes it even better. So bottom line is that that's going to allow you to really see what's the peak readings and then what are the closes above that peak high to really tell us that that's actually starting to really break out. So from this perspective, we're really looking for this kind of a setup here. So from that's a bullish setup. I'm going to go into a chart example in just a minute. In contrast, what's a bearish trend in my work? Well, notice how I've got oversold in quotes because I want to see for a bearish trend it start to go oversold and then keep breaking down. So we're looking for these things to actually sync up. Philip asks, do I wait for both acceleration bands and %R to signal before taking a position? Typically I do. That's going to be my highest probability trades. It doesn't mean that I couldn't trade one without the other, but it's sort of like the philosophy of two rivers flowing into one. If you're seeing two rivers connect into one, you're going to get a much more powerful river when they both flow together than if you're just riding one of the two. So it's going to get you there a lot faster. So, from my perspective, that's the best kind of signals. So in this case, if I get an oversold reading below -80, remember now, -80 is the bottom 20% of readings. Well, then what do I want to see? Well, I want to see a close underneath that bar's low. The first bar, when we went below the -80 threshold, that low is the key that I watched. And if we close below that low, remember, intra-bar action doesn't count. If I'm just trying to test below it, but it keeps hanging, closing above that bar's low, then that's not a good sign. Usually you want to see these things confirm relatively quickly. My rule of thumb for the best trends is that they should confirm within 5 bars after the setup. This first bar's high or low after we get an overbought, oversold reading. So let's look at an example at our next chart. Okay, here we have a chart of MasterCard. That's symbol MA up here at the very top part of the page. So MasterCard is an example where we get a great uptrend back in May and June. Then I'm going to show you in the next chart a more current example we just cashed in on this past week. But here's how this works. Again, this bar back on the left side of the chart. Let me clear the old writings there. And this bar on the very left side of the chart, when we cross here into the overbought status. Okay, well that's what I'm looking for. Is I'm looking for a close above that first bar's high, and you'll notice that next green candle there in early May, as it falls through to about $135, gives me my buy signal, which I'll put a little circle in that bar. right there on that close. That's a bullish confirmation. We closed above that 130 peak on the gap up. We needed to close above that gap bar's high, and we did the very next bar. So that's what I call bull confirmed status. You're getting now a confirmation above that. I should apply to my acceleration bands here too, but that was a close above the acceleration bands. I'll come back to the acceleration bands a little bit later. But, basically this is just showing percent R. Well, for my work, when I trade options, what I've noticed is when you first get this bullish breakout, for me, the first stop is what I call the setup bar's low, which was here about $125 per stop. Well, what I'm looking for is the next time it crosses back out of this overbought threshold, I call this a bull retest here. That bar, or that red candle there, is a new retest off of that bar's low. If we close under that bar's low, which is about $135, then I'm going to get out of that trade. But instead, what I'll do is that sets up my next stop. So what can I do if I've got a very tight stop right there? I can actually add to a position. If I've got half of my position on, but I'm looking to put a low risk retest on, right there on that retest point is exactly where I can get on for a very low risk, high reward entry. At that point around $135, see, we ran up about 20 points up here to about $155 on that peak. That was a 20-point move, more than doubled those options, and in that case, we'd be looking at in the money June 125 calls when the stock was trading about 135. With MasterCard, it's a fairly volatile stock, so you have to give yourself a little bit more room in the money to really get rid of a lot of that time risk. Well, what's really interesting is in this next pullback that the stock had, I remember it well because the stock had a real tanking here on this day when we crossed back under the overbought minus 20 level, and that low was $138.10. I was telling my Option Shark subscribers, hey, we want to buy calls into this nasty 7-point down day, even though it looks like a really nasty red candle, right? Well, why do I want to do that? Because what I've done through testing is I've found that usually this is a bull trend and that's a buying opportunity where other people are getting flushed out and you are getting a great low-risk entry point. But about $139, I sent an alert out to my Option Shark subscribers to buy the, in this case, the July 150 calls. We took a little more aggressive position. The stock was just under 40. But I said I expect this thing to snap up real quickly because it's been a very nice bull-defined trend. You can see it snapped from 140. It ran all the way to 165. We ended up getting out on an average of about 155 for about 150% profit in 5 or 6 trading days. So that was another great retest. Then we got another retest that came right here, right on the dotted line there on the 25th of June. That new low was about $160.50. We tested below it for the next couple days. Notice how you go below it intraday. This is a daily chart. By the close, you're closing just back above it each day. That's what I call a bend but don't break signal. It means that you're really getting a great opportunity to bet that this is going to be a real good low that should hold right there at $160.50. It bounces to about 167, but then it starts to roll over again. You get another retest coming down here right off of this next low. That next low is actually taken out the very next bar right here. So basically that low gets taken out the very next bar, and now you have your exit. I'll put a little ellipse by it, that you have an exit happening on that bar right there, where I've got the down red arrow. So I'm not selling short there or getting bearish. I'm just getting out of my bull position, because now we're back into the trading range where we're not holding, and that tells me that I don't want to get into this position. Now you notice it tries to rally again, and you get another attempted move here, but we don't take out that next bar's high right here in mid-July, and then we break down. The market starts weakening. So the fact that we didn't get the confirmation there was a very good thing for me not getting into that trade. Again, saves me from a fake-out situation instead of a true breakout situation. Okay, so you see how MasterCard then started to get weak here in late July. Let's go to our next chart for a more updated example. Okay, and I haven't put my arrows on this next updated example, but I just want to kind of walk you through what we just did here. And basically, I had to kind of squeeze this in so you can just see kind of what happened. So you can see we missed this whole down wave that happened here. We didn't, even though it's a downtrend, we're just not even trading that. So we're just not interested, even though you see, oh, there's some opportunity there. Well, it's not clear enough to me, so I'm not going to trade that until I get the next good low-risk setup and next good low risk entry point. So the next good setup happens as the stock starts to recover. Right here on this up day here, that high needs to get taken out. That high was about $148. The very next bar, it takes it out. So that was bull confirmed right here on this bar. I'll put a little ellipse by it. And then, so that's, you can put on half your position there if you wanted. We already had some bull exposure as the market was starting to rally after the Fed reaction to the rate cut there, September 18th. But then notice MasterCard comes knocking back down the next couple of days. There's our retest right under the minus 20 threshold, right on that second red down bar. Right there becomes our new stop, just below $140, about $138.85 was the low of that day. So then the next day, I put out an alert to my subscribers saying we want to buy MasterCard calls here after that 2-day plunge because that's a low-risk entry point. You know, if you were kind of just holding your hand over the last couple of weeks of upside action, you'd look at that chart and you say, it doesn't look like that inspiring of a chart. It just looks like it was kind of basing. But in fact, %R picked up that this was a good start of a new uptrend and a good low-risk entry point. So it allows you to see the start of these trends for the rest of the crowd. We were buying the October 150 position for option shark. So again, I recommend in the monies as a good safe way to trade, but I do have some aggressive option services that'll take a little more aggressive position. But when I trade out of the money, I've got to really see the move happen very quickly, or else I'll time stop myself out of a trade, usually within about 5 days if it's just not moving. This one moved very quickly. We were able to double half, which is one of my first rules of thumb, within about 3 trading days on a rumor that Kirk Kerkorian was interested in taking a major stake in MasterCard shares. Now, did I know that Kirk Kerkorian was interested in MasterCard? Of course not. You know, it'd be nice to say I did, but bottom line is I didn't. But I did know that there was some strong buying power developing, and then on the pullback, a good low-risk entry point where the stock should snap back up within a new uptrend. And you can see it snapped up very strongly. Frankly, I ended up selling the rest of my other half too soon at a 262% profit, and it went on to be about a 500% profit on the other half. So I'm not complaining, but bottom line is you can make a lot of money with this kind of an approach if you know what you're looking for. That's what the Big Trends Toolkit offers you, and my indicators will offer you through MetaStock and this add-on. So if you already have MetaStock, you can just add it on. If you don't have MetaStock, Jeff and his crew can give you more information about a discounted way to get started with MetaStock. And at the end of the presentation, I'll give you an extra discount to add on the Big Trends Toolkit for those that don't have it yet. It's fairly new, so I definitely think probably a lot of you don't have it. So let's look at our next example. Well, this is actually just another reminder about what I like to do is I don't sell all the position if it gets a profit of 100%. I just sell half of the position if it gets a profit of 100%. Why? Because what I find is my best ideas are usually going to be right fairly quickly. I don't want to cut my profits too soon. Most people do the exact wrong thing. They cut their profits too quickly, and they let their losers run too long. This method, using %R and acceleration bands and another indicator I'm going to show you in a minute, the efficiency ratio, they only allow you to get on to the best of the best trends. You will never catch the exact bottoms and the exact tops, but you will be able to define low-risk entry points, great places to get on board at the start of a relatively fresh trend that has plenty more potential to it. And I just want to catch the meat of that move, and then I'm happy to leave catching the bottoms and picking the tops to everybody else. That's too dangerous for me or anybody else to do effectively, consistently over time. But the sweet spot is the middle of those trends where we get those real acceleration points where you can really leverage that. So what I found this allows me to do is it allows us to get the emotions out. We can release our fear that we all have of giving up profits, and it allows you to really go focus on letting the trend run based on the indicator. You've guaranteed yourself at least a break even if the other half of the trade crapped out. Of course, we don't want to let that happen. So we'll follow the indicator through to its completion, or a couple other things you can do is you can ride the other half position until it either gives back half of its gains from its peak gains. It went up to 250%, and then it came back down quickly to 125% gain. Well, at that point, I'd get out of the trade. It shouldn't give back that much. You want to let it run until it starts to give back half of its maximum gain, or if the indicator violates first, or exit half again if it later doubles on top of the first double. So if you bought 4 contracts, say at a price of $3, and then it went up to $6, then you sell 2 of the 4, so you've got 2 contracts remaining at 6. If it goes from 6 to 12, You sell another one of the contracts, you've only got one or 1/4 of your original position left at a price of $12. But you're still trying to give it a chance to let it run. If you're buying options, what I find is 10 to 20% of my trades will generate the bulk of my profits. So you can't afford to get rid of your big winners too quickly. You need to cut your losers quicker, and the %R retest method is a good way, along with some of these other tools like acceleration bands, breaking, or what I'm going to show you next, breaking down. So with that in mind, here let's look at a bearish example. It works on both sides of the market. This is a stock called Bear Stearns. Bear Stearns here, BSC, living up to its name, is a bearish play. This is a major brokerage firm. You know, they had all kinds of trouble earlier in the year with these hedge funds blowing up. And so the stock had really been an underperformer. Even while the market was rallying, a lot of the brokers, and especially Bear Stearns, was actually moving into a steady downtrend in May and June. But we didn't even get our strong acceleration signal and %R signal confirming together until late July. So, you know, you say, geez, you missed a good part of that move. Well, guess what? You got the best part of the move. You can see that, you know, every time we break down under this -20 threshold, that's a setup. But notice it doesn't actually close below that bar's low. We go look at each of these potential bearish trades. None of these confirm, these first several, that low has to get closed below, and we're not getting it. You can see coming close, it's just not quite happening. So we're getting these situations. Let me clear out the last charts. Just getting these situations at which you're trying to break down, you just can't get going below it, and then the %R snaps back over that -80 threshold. So each time this happens, I'm not interested in these trades here, folks, because it's got to close underneath that setup bar's low in order to get me into the trade. None of those happen, and so I'm going to clear those, but here's where it does happen. You can see on the bar that I've drawn the vertical line in here, we're getting ready to close underneath that low. It doesn't quite happen on the next bar, but it does happen right here. So on that bar right there, you're getting a situation right there where we're getting a close below that low at about $130. Now, I was actually looking at the 140 strike puts at the time back in mid-July, and, you know, we were about 10 points in the money, and you had to pay $13 for them out into mid-August. You say, well, geez, you know, that's a pretty expensive option. Well, it was the right choice. You know, you only pay about $3 a time, and you get about $10 of intrinsic. That's a pretty good ratio. So from this perspective, we're looking at a situation in which, okay, we've got about 75% intrinsic. We get a quick drop from 130 to 120, and then notice what happens. We get a quick snap up here a couple bars later, right on this bar here when we go back above the -80 threshold. That's my next stop. That's my next retest point, right about $128. Now, interestingly, the very next morning, it actually gapped open above our closing stop. My stops are end of day, folks. It's not an intraday stop, end of day. At the end of each bar is where I get out of the trade if it violates that next stop. Some people get worried about this and say, well, you're taking on more risk that it may move further against you by the close. And every once in a while, that'll happen. I'll end up taking a little more of a loss than if I'd used an intraday stop. But more often than not, I'll actually stay in trades that I would have otherwise been faked out of. You know, my closing stop was 128. It opens the next morning at 130, and I don't use that as a chance. I don't tell myself I shouldn't get into that trade. I'm actually willing to get the other half of the trade on there and say, look, if it closes above 128, I'm gone. Instead, it closes back down at 121 and change. So you've gotten a great entry, a fake out of the early traders in the morning, and then the close determines who wins the war. So don't get shaken out by the intraday trades. Really focus on the closing levels. That'll give you an early enough uncle point, but it'll allow you to stay with the trend. So this gave you the chance to get the other half of the trade on the retest, right back near 130, and then it goes all the way down here to $100 on this bar. Then notice, there's our next setup, because it starts to rally back by the close, right around the $115. Very next bar, it actually says you got to stop that trade out, because it closes above 115 there, right here at about $118. So at $118, you got to say sayonara. It closed above 115. You get out of the whole position. You've locked down a nice profit. You already sold half at more than a double on the gap down, and then you're just stopping the rest out for still a very nice profit. So that's how it works on the downside. You can see then we weren't, even though it settled back down a little bit, we weren't breaking back down under the -80. So if we had and then set up again, it could have given us a way back in, but instead the stock stabilized and then managed to bounce back with the Fed in September. So bottom line is it kept us out of trouble once the best part of that trend was over. But notice, you can see here that clearly the best part of this trend is happening through this phase here. We're getting that accelerating parabolic type of move as we get that confirmation and then that follow through. So that's what I really care about. You can see it's a much stronger slope of downtrend through that phase than it was earlier in May and June. Okay, so that takes us into our next example. And I want to talk a little bit about the efficiency concept, because efficiency is very important to me when I'm following the trends. We really have a situation in which I want to be trading very efficient trends. For example, if I tell you that you could buy a call, so I'm not just going to say a bull position here, but I'm actually going to say a call position. So if you could buy a call position on either of these stocks, I'm going to say there's a stock in red here that's a tech stock versus, say, a stock in white that's, say, a utility stock. And in both cases, you know they're going to go from the beginning point A here to the end point B on the top right. You don't know every little squiggle that's going to happen in each stock, but you know that you're going to see a situation in which, say, the tech stock's got twice as much volatility in red as the utility stock, the less volatile stock in white does. Just ask you just to type in the chat window, how many from the beginning point to the end point would rather buy calls stock in white? Just type in W for white. And so, and then how many would rather buy calls on the stock in red? Just type in R for red. I'm just curious. Usually I get a fairly mixed response in all the seminars that I do, because those that say red, you're usually thinking, hey, I'm getting a lot of volatility, right? And those that say white say, hey, I'm not getting as much volatility. I can sleep better at night. And you can see that most of the responses here are pretty much along those lines, about half and half, split down the middle. Well, remember how the options pricing model, the Black-Scholes model, prices options. It says that the only unknown factor is volatility. So therefore, it's saying what? It's saying that if something is twice as volatile in red compared to white, well, then guess what? All the factors being equal, time till expiration, the price levels of the stock, say we're looking at an at-the-money option in both cases, well, both stocks are at 50, they're both making a move to, say, 60, but you're paying twice as much volatility for red's options, you're going to have to pay up twice as much premium for red's at-the-money options compared to white's. And so, therefore, you're paying twice as much for red's options, which means you're going to get half the return on your investment from the beginning to the end point in red. You're going to get twice as much return on investment for your white call options compared to your red call options, thanks to the options pricing model assuming that volatility is the only unknown factor. Clearly, another unknown factor in my book is the amount of trend you're getting. Ironically, the options pricing model says that there is no trend, and so that's where we have a big edge in finding the best trends in the market and exploiting those. But the steadier the trend, the more efficient the movement, the better. In the case of red, it might be 2 points up, then 1 point down, then 2 points up, then 1 point down. Or in the case of white, it might be a half point up, then another half point up, then another half point up, then another half point up, without any pullbacks in this example. So you're not getting as many shakeouts, which to me is great as a trend trader, because it's going to make you able to stay with the trend longer, because it's so much more predictable and steady when it's making that steady movement without any negative movement against you in this example. Whereas some people say, well, I like red because I could trade it up, then I could trade it back down, I could trade it back up, I could trade it back down. Well, if you're that good, then you probably should be on your own island trading on your own yacht. And I've just seen that nobody's that good. And in fact, red, the more volatile, the more whipsaw and noisy the action gets within that trend, I find the more risk you are of getting faked out. And so I don't like that kind of excess negative noise against my trend. So we want a stock like white that's going to be steady and predictable, but hopefully even better accelerating. So let's look at an example in our next chart. Well, here's where we start to combine indicators. And basically what we're looking at in this chart, this is back to American Home. Remember I mentioned before on the breakdown of AHM, on the downside, we mentioned the couple of windows on the downside through here back in February and March. And then remember I mentioned that potential fake out right there back in early April. Well, look at the indicators up here. We've got the percent R in the top panel of the chart. We've got the efficiency ratio in the middle panel of the chart. And what I find on efficiency, by the way, in this case for a negative trend, is that this reading here is about minus 30. Let's type that in here. Minus 30 is my key threshold. So if it goes under minus 30, that lower blue line there, that's going to be my breakdown point. See, I've got minus 80 up here is my breakdown point on the percent R indicator in the top part of the chart. So you can see that right up in there. Okay, so basically what you notice is that when efficiency also broke down under minus 30 and percent R also was broken down below minus 80 and confirmed, that was happening about just after we got the breakdown in the acceleration bands right there. From about $27 right in here, we still had a good move from about 27 down to about 20.5. So plenty of potential to double that put option. Then look at this next move when the percent R starts to break down under minus 80, but efficiency hasn't even gotten under minus 30. It's more like minus 20, minus 25. You're just not there yet. So we're not getting the confirmation on that breakdown of the acceleration bands in early April. So I don't like that move as much because the other indicators underneath the acceleration bands, the ones on top of it here, are not confirming that tool. Now you notice the next time that they all broke down together is right here as we got the gap down back in late June. See that efficiency had broken under minus 30 here. The percent R had broken down under minus 80, and we'd gotten that breakdown here in the acceleration band. So that actually went bear confirmed on this bar about 4 bars later when it closed under that first gap down's low, down about $17.50. If you're buying 20 strike puts for about $2.50 intrinsic, it was costing about $4. They were pretty expensive options, but still a $4 20 strike put went on to be worth more than $15. So it was worth about a quadruple on that gap down by the time it hit under $5 right here in this bar. So that's when we said thank you very much on the remainder and got out. So that's what you're looking for, is that kind of setup. Now notice through that whole downtrend, we never got back above the minus 30 threshold for efficiency. We almost, but not quite, got a retest in the percent R reading right here. So, you know, we really had a really steady downtrend. And that's what you're looking for, these steady opportunities here, in this case to the downtrend. That's an example of how you combine the indicators on the bear side. What about the bull side? Well, here's an example with Crocs. I'm sure some of you have followed the shoemaker Crocs. C-R-O-X is the symbol. And what you look at is that we're looking at a situation in which everything crossed. The percent R actually came on a little bit later in this example on the middle panel than the efficiency ratio did, which already was above, in this case now plus 30 being just, in these, perfect efficiency would be plus 100, by the way. Perfect minus efficiency would be minus 100. But what I find is once it goes above plus 30, right in here above this upper blue line, that plus 30 is the key threshold that I want to see it take out. So if it takes that out, then I've got a good opportunity to really see it cruise on quite a bit higher. You can see actually that was the first breakout. We actually closed above that bar's high a couple bars later, and then we had the bull confirmation happening. So it was bull confirmed right in this area right here. This is early to mid-April. And then notice we also got what I call a double retest, where both efficiency and the percent R both tested down here, right on this little red candle right here. And that red candle was never violated. And you can see then it starts to take off. A week later, it has an earnings gap to the upside. And then you can see, look at how long these things stay overbought, stay in that really strong positive efficiency, all the way through this zone right here, and all the way through here. And then notice we're getting our next retest happening. And that's, by the way, of course, you can see what's happening with the stock. It's just going ballistic all the way above the acceleration bands. And then we get a break back into the bands, but actually we do get a nice retest right here when both of these lines on this real nasty bar here, both of them come back down under their retest levels. That low should hold. That low is $40.41. And I told my coaching clients that night, actually, I said after the close, I said, this is a great low-risk retest. Even though it's back into the bands and it's probably just going to trade back near its upper band, you could trade it from $40 to about $50. We ended up buying July 40 strike calls when the stock was 41.5. ended up making more than a double on them as it ended up snapping back all the way up here to almost $50. We actually got out a little too early on that move as well at about probably 46 for more than a double. But bottom line is that was still, we were concerned about time at that point with about a week to go. And if you're ever running into a problem where you're running out of time, you can always sell the Julys in this case and go buy the August. That was another approach you could take. But we were able to just scalp it on a low-risk reentry right off of that next test. So that was just another great chance to get on board. So this is how you use the indicators in combination. And we do this for our recommendation subscribers. And you can certainly get more information on that through our 800 Big Trends number, or you can email me for more information on that as well. But basically, that's a good way that you can start to combine indicators. So I also want to give you kind of a bonus indicator tonight. This is the percent above the 200-day indicator. This is another great tool that I developed after somebody told me that they'd missed out on Taser years back and the big move. And I said we'd made a lot of money on Taser. And they said, oh, I didn't buy it. It was too extended. It was a moving average. That got me thinking, well, what would happen if we go and test that? I wonder how that tests, because these stocks that move can move a lot more than you'd expect. Well, we went back and studied these stocks when they go 100% or more above their 200-day simple moving average. And here's what we found. The surprising result is that these stocks tend to lift off a lot more from there. And so it's sort of like the analogy of going into orbit, that once a stock shows it can move a lot, it gets away from sort of that kind of gravity of Earth, if you will, starts to really get away from that, starts to really take off away from that 200-day. It's a sign that that stock can move a whole lot more, kind of coast on its own. So my rule of thumb is that if a stock goes 100% or more above its simple 200-day moving average, well, we've got to see a close above that day's high. Just give me a confirmation. So much of what I do is based on confirmation to get a new buy, to show it stock really wants to keep moving. Then I'll set a stop if it crosses back under the 100% line to give me a new closing stop at that day's low. So that's what I'm going to key on here. Let me give you a couple of examples. This is a stock actually that I recommended on Fox News back in early June. And it was TBSI, TBS International. It's a dry cargo bulk goods shipper all over the world. And what you have up here on the top chart is the percentage that the stock is above its 100-day or 200-day moving average based in percentage terms. So this blue line going across the top half of the chart is the 100% above the 200-day moving average. I haven't actually plotted the 200-day moving average below, but I'm just doing a close of today's stock price divided over the current 200-day reading to give me a day-to-day reading. And so what you notice is that here at about $19, $19.50 I think it was, we got that first setup. Even though the stock's already moved from 10 to 19, it's saying, look, at 19, the 200-day is down at about 9.5. So that's giving us a signal to say if it closes over 19, this thing's good to go. It's going to want to rally even more. So it did that the very next bar. It closed about $21 right there. Very next bar. So that was bull confirmed right there. And that's where the MetaStock software is so helpful, because through the Big Trends Toolkit, it picks up that we are actually in a bullish situation here. So that it spots that. You can see the market kind of was a little choppy, but you see then we get this next test right back under the 100% above the 200-day line, and so that actually sets up my next stop. But it's also a great place to enter, and you can see that sets up the next launching point. The MetaStock software picks up the next time it crosses over the 100% threshold and then confirms, but it's already holding that stop, so it's still good. And you can see just how nice of an uptrend that is. That thing, I recommended it on Fox back at the beginning of June, back about $22. It went from 22 to 45 for a doubler. Even when the market stank, it ran up here to early August at 45 for a doubler. Of course, if it doubles, I sell half of my position at a double, even on a stock, not just in an option. So you're able to mitigate that risk, and when the stock comes back down here, you can see it's giving another retest setup here. You're getting another low-risk entry point right there, and you can see then it snaps back up. And since then, it's been kind of giving us several retests and kind of keep hanging. But it actually just broke out again here. And notice it just followed through right above that bar's high and was confirmed again right here. And then we just broke out again today to all-time high and breaking out of this old base as well. So this is still a very fresh idea, one that's acting very positive, and one that I'll be looking to use shorter-term tools like the %R to further buy the short-term dips and maybe trade some options against TBSI in this case. Another shipper on the next chart that we also have done very well with this year is dry ships. This is probably one of the leading stocks on the board this year, and is optionable and doing tremendously well. And you can just see, it broke out and gave the bull confirmation on the very next bar right here. So put a little oval by that. Now you notice that the first moves were holding as we get the retest. This next retest back under the 100% threshold was holding at first. Then it actually did give another retest that violated. Level was taken out right off of this low. So you can see that's where it's telling you that we're getting an exit, which is true. You're getting out at that point. So you didn't get a huge lift out of that first move. You can see it gets you back on for the next time we cross above, and then we follow through on the very next bar. It's telling you get back on board here in July. We get a nice quick rally. Look at the next retest point happening right here off of this low. You can see how nice that's holding. And so you can see that then we get the next takeoff. And look at each of these retest points. Great retest right there as we went back 100% under, just under 100% threshold. And this last one was golden. We bought calls right here on this last retest, right off of this low, about $68. Since then, the stock is now almost doubled that. It's $115 at today's close. Huge mover. Great low-risk opportunity. So that's what I'm looking for these kind of very selective trends. You get a great opportunity to really ride these trends for big moves. That's what we're after here is really finding the biggest and best trends for you, and the Big Trends Toolkit and MetaStock will help you do that. Now, I've only covered just 3 of the 14 indicators that I use and tools that I use in the Big Trends Toolkit. What I've done here is I've kind of highlighted a number of these tools here so you can actually really keep an eye on it. But basically, it's all the stuff that starts here with BTTK, and so you can see here that we've got my acceleration bands. I use both a 20 and an 80-day acceleration band. A very unique tool called DMI Difference that we haven't had time to cover tonight in this hour and change, but basically it's a great tool as well. We did talk a little bit about efficiency ratio. The force index is an indicator Alexander Elder developed, but I actually tweaked it based on testing to give you the real true trends in the market. I've got a divergence indicator here. You can see divergence is going to help you really spot when you have a true breakout versus when you have a fake out. You can get my favorite market timing tool, the NASDAQ relative strength versus the S&P. And all this is covered, by the way, in my DVD course as well. So if you're interested in a special savings on my DVD course where you can get not just 1 hour of this kind of training, but actually 15 hours that you can watch again and again from one of my 2-day seminars that I no longer do at 2-day seminars, just too wearing. But that's still very fresh, and you'll definitely enjoy that. %R indicator and some setups based on the last couple of days of %R, the percentage above the 200-day and 400-day, and then also a different way to use stochastics. This toolkit is a really great way to really find the best of the best indicators. TJ asked, can you use my indicators intraday? Absolutely. These same tools apply intraday as well as end of day. So you can use them whether you're a longer-term trader, a swing trader, a position trader, or even a day trader. It works across all time frames. You can also use them across other vehicles, not just stocks and options, but also Forex, futures, ETFs, you name it. It works across all those different. So at the request of Jeff Gibby and our subscriber base, since we're just really getting this off the ground, we're actually getting you started at a discount compared to what you can normally get it at. The MetaStock program is usually for the MetaStock itself, that's a separate charge, but for our Big Trends Toolkit as an add-on, the add-on itself is usually $399. And then we're taking $50 off here, so that's just $349. Tremendous value for 14 indicators. If you broke it out by indicator, that'd be less than $30 an indicator. So basically tremendous value, but think of what the cost of a good trade missed, or if you make a bad trade, what does that cost you in your portfolio? What does that cost you in your trading confidence? Probably a lot more than $349. So this is just I've made this attractive because I want you to get started. I want to see you making money. I think when you see the value of this, you're going to keep coming back to Big Trends Education again and again more defined trading edges. This gives you not only all 14 of the indicators, but it also gives you the trading scans. The trading scans will actually run through any group of data you want, whether it's the optional stocks, whether it's all stocks, NASDAQ stocks, NYC stocks, futures, you name your tool, the Forex pairs, anything you want to run through, it'll actually run through and tell you when there's a new signal across acceleration bands, across percent R setups that I like, across efficiency ratio, across any of those other tools I just showed you. So it really, really makes it a lot more effective for you to really take advantage of that by not having to go do all that work yourself. Frankly, I just set my scans to run after the close, and then I can go ahead and just go ahead and pick it up when they're done. It'll just pop up with a box that tells me which stocks are giving me buy setups, which stocks are giving me new sell signals, which stocks are giving me exits once I'm in a signal. Very clear cut, very easy to focus your resources and your mental capital as well as your financial capital on the best of the best situations. When you call us or email us, just mention this code here, BTTK save 50, and there's no other one in place now. It's just, this is the only one that's in place, so don't try to save 400. That's not going to work. Just the save 50 will at least alert them that you are aware of the $50 savings from tonight's webinar. It's something we do for you having made the commitment to come into tonight's webinar to extend your trading education, take your trading to the next level. And there's really two ways to get a hold of us. You can either email us to the service@bigtrends.com address. That'll be a way to email, and then my staff will get back with you likely tomorrow. And we do have a couple of staffers standing by right now if you want to give them a call. If the number's busy, pardon me, but I know there's probably going to be a lot of demand for this at the $50 off to get started, start taking advantage of this. Whether you already have Metastock and are just adding this on as a plug-in, or whether you also want to add the Metastock software. Either end of day is a little bit cheaper, or if you're an intraday trader, you can add the intraday, which gives you the whole package. Metastock Professional, that's called, including the intraday, or just Metastock end of day. But either way, the 800 Big Trends number is the way to get a hold of us. That's 800-244-8736. So the 800-244-8736, that's just 800 Big Trends, will get you that. My staff will get you more information on that and the $50 savings if you just mention that code. Remember that code. It's BTTK, save 50. So keep that in mind. Does anybody have any questions? Larry looks like he might have a question on Metastock. And I know Jeff may have some comments he wants me to relay. If you do, Jeff, just IM them over to everybody or to me, because we can also have you contact Metastock directly. Jeff, if you want to put that up through the Q&A window, feel free. Any contact information for Metastock as well. But I appreciate everybody coming tonight. We are archiving this presentation, so we will be doing a follow-up email to everybody with tonight's archive. Jeff says to tell all of you all that I did a great job. Thank you so much. Well, Jeff, you and your staff at Metastock have done a fantastic job with just tremendous software, unbelievable power. That's why I chose Metastock, my coaching program, in addition to really featuring it through these kind of sessions, because it really gives you the power to not only go find the best of the best trades, you can also do, as you get more advanced, you can do your own testing on it. You can go set up combinations of my indicators to actually say, okay, now let's use 3 of Price's indicators to actually set up an even tighter filter, show you the further best of the best situations if you only want to trade just those best of the best candidates. But this will get you focused on each small group of stocks based on each of my favorite scans, and then you can see just how well they're doing, whether you want to paper trade them at first, or once you get comfortable with them, starting to put your own money into it. Obviously, you know the cost of missing a good trade is well more than a few $100s, and the cost of making a great trade, the opportunity of that is so much greater as well. You know, a lot of people say that the cost of education can be expensive, but I always say the cost of ignorance is a lot more expensive. So, you know, it's just amazing how just getting one key tool, one key indicator, you don't have to use all 14. Even just using one of these, I think is going to give you much more tremendous value than the great price point we've got on it for now, $349 for the whole toolkit. That's a one-time charge, folks. We're not doing this every year. We've gotten some confusion on that. This is a one-time only charge for the Big Trends Toolkit. With Metastock, You buy the software for a one-time charge. You do have to pay Metastock for a monthly data charge, but you can work all that out with Metastock, whether you're using end-of-day, it's a little cheaper than intraday, so you can just figure out what kind of trader you. You can make a lot of money on this just running it in each night and then placing your trades the next morning. And if you ever have questions, too, we're really good about being here for you with the follow-up. So you can always email us, and I'll get any questions related to you using the software more effectively, and that will allow you to really take full advantage of it. Have I answered everybody's questions? If you had any final questions before we wrap it up tonight, make sure to submit them through the Q&A link, and make sure to call us at the 800 Big Trends number. We'll be able to really get you more information about how to use this effectively and how to take advantage of this special offer. It's just good for the next 24 hours, so make sure to act quickly because this price point is probably going to be going up. It's just too much value, in my opinion, to be giving away. We're kind of testing this low price, see how much value we get on this versus a likely higher price to come in the future. Usually $3.99, now just $3.49 for you here over the next 24 hours. Make sure to either email service@bigtrends.com, or if you want immediate attention, call right away. I've got representatives standing by at 800 Big Trends. That's 800-244-8736. So that's right here on the bottom of the screen. Make a note of it, and I'll hope to see you again here real soon. Really appreciate everybody coming along tonight. It's been a pleasure to have you on board, and we'll look forward to serving you with more great trades, more great setups to really allow you to find these next opportunities. One more question. Adrian asks, do I always wait until the close of the next candle to see if it closes below? Excuse me. Yeah, Adrian, I do. Whatever time frame you trade, if you're a swing trader trading the intraday time frames, you can tighten this up. For example, I use an hourly chart for shorter term trades, so you can follow every hour's close. So you don't have to wait to the end of the day. If you're more of a position trader, I recommend 4 to 6 weeks out using the daily chart. It's going to give you the truer trend across the next 4 weeks or so. But if you're maybe a swing trader, 2 to 5 days, I'd key on the 60-minute chart. If you're a day trader, using a 15-minute chart can be effective. But, I watch the end of each of those bars. Whatever time frame I trade, I watch the end of the bar. It's much more meaningful to me than the inter-bar action. You're going to get faked out too much. Even on an hourly chart, I've seen so many times where it looks like it's breaking down during the hourly bar, but then by 10:30, 11:30, 12:30, 1:30, 2:30, 3:30, or 4 o'clock close, each of those hourly closing points is what you got to watch once you're in the trade on a 60-minute chart. So define your time frame and follow that closing point of each of those bars through. That will make you a much more effective trader. You'll still have enough of an uncle point to get out quickly enough if it doesn't hold, but you'll save yourself a lot of those fake outs and you'll stay with the truer trend. So it looks like we covered all the questions. I've gone a little over our normal hour time frame here, about an hour and 15 minutes. I want to thank everybody for joining us tonight, and we'll hope to have you back again real soon on another presentation. Have a great evening and a great week ahead of trading, and we look forward to serving you at 1-800-BIG-TRENDS, and that's service@bigtrends.com. Email us or call us if you have any questions, and we'll see you again real soon. Thanks, everyone. Good night.